can be very stressful for a lot of people, and it's especially stressful for people who overbought. Let's call it what it is. I've had conversations with people who lately they they came to me that they basically expanded too quickly. They took on too much debt.
Yes.
I know of a couple of people who they just kept refinancing. They have a blank. They own quite a few properties, but what they did was they took and they started building equity in these properties, and then they went out and they took these large blanket mortgages to pull out even more money, and they invested them into different types of things, passive developments, but the developments are delayed and the mortgages they renew. They're lucky if the lender renews. They're stuck ordering appraisals and trying to prove the value is still there, and then the rates go up, and it's really a mess. So I think the lesson is that the days where you could just buy real estate and do nothing and then just wait and think that it's going to go up in value. I mean, it might do that, but it's not always going to do that. If you're not forcing the appreciation, if you're not doing something creative to improve the rents, to use some spare if you have extra land there, put another property on it. Um, adding units, changing the zoning. You got to do something. It's not enough just to buy and maximize your debt and just go keep buying. Obviously, you can see that's really backfired for some investors.
That's true. But on the other hand, those investors who are leveraging way too much, they're not in for a long term, they're in for short term. If you have a positive cash flow, if you are aware of the fact the mortgages can go up and down, there will be some rainy days. If you have 1 year's for 6 months of emergency fund, you're okay. But otherwise, you could be out for lunch and things are not that good as we speak. As a matter of fact, there was a headline that an average detached home in Toronto have dropped by 5% alone in month of June. So there's too much inventory building up, and that's very unfortunate, though.
Yeah, it's a lot of inventory
Yes, tons of.
building up, very
All right,
much so.
well, yeah. So we're gonna get cracking, and there are a couple of things. You are also a you have a license for
Yes, I'm a licensed dealing representative.
perfect. Okay, and
Yeah.
yourself as well as I believe Jerry Hogenhout is also.
No, he's not. He's not licensed currently, as far as I know, as a dealing representative.
Okay, all right. Well, there is a gray area. This is where I want you to.
But
Uh,
he knows a lot about raising money. He does
yes,
lectures on that.
right. So we also have Shelley Hagan. She has done tremendous job at Nova for a long time. Uh, we also have Vladimir who've done a bunch of deals with us. I mean, everywhere, raise the capital in different way, but different scenarios, mostly with joint ventures and fractional ownership and so on. And we also have Jyoti on the line tonight. We have about 4 or 5 speakers, and a couple of other ones may gonna join us later tonight and see. So far, so good. So we're gonna get rolling, even though not Gary is here. Sorry, Jerry is here, and Jerry is here. Jerry, can you hear us loud and clear? Jerry Hoggenhout.
I see him.
Oh,
Okay,
hello. Yeah, I'm here. How you doing?
excellent, very good.
Hi,
Jerry, are
Jerry.
you also a dealer for the Security Commission?
Sorry. Yeah, sorry. I didn't grasp that.
I said, are you licensed as well to deal with the securities?
No, I was.
Okay, that's fine. Thank you. I just want to make sure that we stay on course and I do not pinpoint. Well, let me introduce everybody. Good evening, everyone. tonight is the night we're going to be talking about raising capital. It can be through joint ventures, fractional ownership, and maybe many, many other ways. And make sure you get advice from a professional person, whether it's a real estate lawyer, mortgage broker, or again, if you are dealing with something to do with raising a lot of capital, security commission. So we'll be giving you references. I want to give you some good news. Those who are paid members can get the PDF files from us at the same time. And we have prepared few slides for you, which can be extremely helpful. And that should stay in your notes forever. We're going to talk in general first, and then we're going to get to it. Make sure that information we are providing is only for education purposes only. Make sure this is, we don't take any responsibility. All the investments are risky. Make sure you verify information before you apply it in real life, though. So we also have tonight is Jyoti Chaudhary. She's an attorney, the lawyer, law degree from India, UK, and Canada. Has been practicing law for a long time, helping a lot of real estate investors across Canada. We also gonna have Jerry Hogenhout. He is right here. He's CPA. He's also an investor. I believe he have license from our 5 different and separate regulated investments. So that is Jerry. He's here tonight. We also gonna miss our friend Randy Goodman. She got stuck with something else, but she's one of the award-winning. I think she's bestseller, international seller for a long time, and she's the top-notch broker. That's myself. And we have David Grossman, who has been a mortgage broker for a very long time. RockYourMortgage.ca, that's David Grossman. And we may have Ken Chung. He have not joined us yet, but we also have Shally Hagan, Go Big or Go Home. And this is something she's one of a great person to be involved with. Go dream big. She is an incredible human being, by the way. So we're going to be talking about raising capital. And I want to make sure that all the information we are providing it to you, we're going to give you some references. This most information came from the Government of Canada and their websites, and make sure we follow exactly all the rules and regulations. And all our speakers will be able to help you out to some degree. So I'm going to start with David Grossman. David, raising money, utilizing the money for RSP, TFSA, and LIRA for mortgages or investments. Can you please elaborate on that?
Well, yeah, if people want to invest in private mortgages, those mortgages can use funds that are in a registered account, like an RSP, TFSA, or LIRA, or any registered account. We typically work with Olympia Trust on this. Olympia is the trustee, and people can put new cash into an RSP or TFSA, or if they have an existing TFSA or RSP, they can take that, convert it into cash. Let's say it's not with Olympia, but maybe it's one of the banks. They convert it into cash. You're not actually taking it out of the registered account, and then you move it over to Olympia Trust, and then from there you can invest into mortgages and other types of very good real estate investments without ever taking it out of the RSP. So definitely people can invest in private mortgages, in other good passive real estate investments using their RSP and other registered accounts.
And they utilize this money and become a part owner of a deal.
Well, they can purchase shares. I mean, with the I'm licensed as a dealing representative in addition to being a licensed mortgage broker, and we have different products on our shelf. For example, about a week ago, I did a webinar with Polis or Lankin, and they are an apartment REIT, real estate investment trust, and people can own shares of a particular project where they own shares of a particular apartment building, or they can own shares of a mix of a variety of apartment buildings. and Pullis has generated returns, anywhere from 10 up to 20% annual. They have a few different types of funds that people can get involved with. And yeah, so they would own shares and they can use their RRSP money for that. Exactly.
Great, thank you. Shally Hagan?
Yes,
Shally?
so yes, thanks, Navtash. So I do help people lend their RSPs as well, which David had talked about. Um, Typically for short term, somewhere between 6 months and 1 year, occasionally for longer. Typically, a lot for investors who want to borrow some money for, a flip property. They need some rental costs, etc. So David has, covered off most of it, but we do a lot of trust funds. We don't have access to REITs, etc. If the clients want to use their money for that, they would find that through an EMD or some similar kind of group that would have those approved by the securities commissions to lend on them. But we do a lot, and I've lent my own RSPs, etc. Olympia Trust is the one we use. I have used B2B Trust in the past myself as well.
Great. Sherry Hogan-Hout?
Hi, yeah. So this is certainly a strategy and structure we use a lot. And as David and Shelley have mentioned, we can channel that money. It stays inside your registered account. Again, a RSP or a LIRA or a TFSA, that in itself is not an investment. It's just a vehicle to hold investments in. So, if someone has mutual funds inside of their RSPs, we can cash it out inside the RSP, use that cash to lend as a mortgage inside of that RSP. And a couple of things we do, we've done this a lot where we use the mortgage inside of somebody's RSP for them to become involved in a venture as a joint venture partner, where we actually send back as little as possible as far as an interest rate back into the RSP, and then create a joint venture agreement outside of the RSP where the person can earn the most of that income outside of the RSP. And that's a strategy we use a lot. And in essence, it's basically using your RSP money to earn income outside of your RSP. So that's a strategy we use. We're also creating. So if people want to invest into a specific project, as David had mentioned, we can hold a mortgage inside of that RSP and they can be a lender into the project. But if they want to buy shares using their RSP money, shares or mutual fund trust units, into a project, we need what we call an MFT, mutual fund trust, for that RSP money to flow through. And then within the right structure, they could actually become investors as shares of these projects. So that's what we're creating too right now. So lots of different angles and avenues when we look at registered money. TFSA has hit our radar a lot more. Previously, those TFSA, the limits were relatively low. Not much we really could do with 30, 40, $50,000 inside of a TFSA, but now the limits are up to $100,000. So TFSAs, now we set up similar structures to use that registered money. Everything you've mentioned there, RSPs, LIRAs, TFSAs, are what we call registered accounts, which means we need third-party trustees to facilitate any of these types of investments that we're talking about. But this is, there's a lot of registered money out there. The mindset of investors, I find, are quite different between if we're, asking them or showing them investments that they can use for with their money outside of the RSP compared to money inside of the RSPs. People seem to look at their money inside of the RSP a little differently. And it's easier to access. People, they're kind of looking at that more longer term. Okay, I don't need this money for 20 years, so let's do something with it now, and let's do something, to make some money, and then we can always put in a different project. So I just find the mindset of the investor is quite different between registered products and what we call non-registered products, but definitely a good source of funding. And it's just important that people are made more aware of the opportunities that they can use their registered money for. So, good topic, and certainly something that we use a lot in our business model.
Jyoti, you registered a lot of mortgages as the money come from TFSA or self-directed RSP, or it comes from LIRA. Your input on this topic?
Well, there are private mortgages and there are mortgages from the A lenders, which obviously are coming from the banks. And the private mortgages can come from private individuals who can also give the mortgage through Olympia and through the other methods that Jerry and David spoke about. So as far as the law is concerned, the process or the modus operandi of registering the mortgage is the same, whether it comes from an A lender or it comes from a B lender or from Olympia Trust, or if individuals are getting together to lend money and their shares are enumerated in the charge as say 20% so and so, 10% so and so. I have done mortgages where up to 8 to 12 people have lent small amounts, and it has become a big enough amount for the borrower to borrow the money and buy property. So that's a good part.
Thank you. One thing I'd like to remind you, all these things are regulated by CRA, Canada Revenue Agency, and it has to be done through a proper channel, and they are heavily regulated, by the way. Well, the best thing is when it comes to about RSP, TFS, LIRA, people have a lot of money and they're sitting in what? In GIC. The moment you mention to them, hey, listen, I got real estate investment, your money is backed up with a real estate, it will be secondary mortgage or second mortgage, and you let them know one thing for sure, and that is something will set you free. Every investment carry risk. The moment you let them know there is a risk involved in every investment, they're comfortable. Then they will need to know, listen, make sure you got independent advice before you lend the money to anybody. It's always a great practice in real life. And make sure they have a letter from a lawyer and saying, yes, I review the documents, I recommended him to proceed with it, or this looks to be legal and more and ethical. So this is very important, otherwise it can backfire on you. Again, there's tons of money, trillions of dollars sitting and earning less than 1%, where you can offer them 4 or 5%. The best way, in my opinion, is offer them, hey, what are you getting? GIC? How about if I give you GIC or double it up or triple it up? Is it okay if I give you 5 or 6% return on your money? Another thing, what you can add it up, you can say, listen, all these three scenarios, you don't need to have a monthly payment. One of the best secret for investors is, hey, can I make a one balloon mortgage payment? I'll pay you all the interest upon what? Upon maturity. If I borrow money from you, $100,000 at 10%, and for next 5 years, I'm not going to pay interest every month. So that can help the cash flow. It can give us a lot of leverage. It can help you to go through some hurdles. Again, these are the certain opinions, and we will have other experts giving in a lot more advice for you. So, understanding the Canadian security laws. David, are you able to see the slide?
Yes, I'm able to see the slide.
All right.
Well, I mean, this is a somewhat complicated area, and if you're serious about raising money, I would recommend somebody to speak with a securities lawyer because you can get in some trouble if you don't do it correctly. If you want to go out to the public, you can, you want to be on the stock exchange. If you want to do it privately, and there might be some exemptions that can apply if you're going out to friends and family. But if you want to advertise, then I believe you're going to need to go through an exempt market dealer. So, take caution, speak with a securities lawyer. And as I mentioned earlier, I know this is an area that Jerry knows a lot about. He lectures on this, I think, if I'm not mistaken.
All right,
Just give me a
Jerry?
second.
Yes, you are right, David. Okay, so yeah, this is I'll make sure now. Yeah, this is a little. I worked in this area for a long time, so I'm quite familiar with what goes on in this area. And you're right, David's right. It's a complicated area. Um, Even complicated for us that work in the industry that David and I do. So in simple terms, again, what's on the screen here really it relates to what we call private equity. And in very simple terms, we're either dealing with public equity or private equity. So public equity is just having stocks in the stock market or having mutual funds in the stock market. That's what we call public equity. What's on the screen here and what David and I have talked about is private equity. So what it really means is there's all these rules and regulations that govern and restrict the amount of your money that you can put into private equity. And it might just be my opinion, but I think I'm right. They make these rules very complicated, very restrictive to take money out of the public market to put into the private market, simply because the public market is the golden goose, not only for the government, but for banks. And the banks are in cahoots with the government. So little skeptical me has always said, boy, they make it really difficult for Canadians to put money into private equity. And I think one of the reasons is because they don't want to lose the golden goose that exists in the public market. Now, the one thing we're probably all real estate investors. So one area where we can stick handle around these rules, and it indicates securities laws. Securities are shares and mutual fund trust units in very simple terms. So if we're not dealing with shares, if we're not dealing with mutual fund trust units, we're really not being governed by this law. And what does that mean to a real estate investor? It really means that if we're just doing joint ventures without share ownership, we're exempt from these rules. So we are allowed to go out in front of people and say, hey, why don't you joint venture with me? As long as we're not soliciting the sale of a share or the sale of a mutual fund trust unit. So I know a lot of the joint ventures we do, and I'll just keep a simple example. If we have a joint venture opportunity and we're bringing in investor capital, if we're advertising and if those investors become shareholders, we've crossed the line because they become a shareholder of our corporation. If those investors do not become shareholders and are simply providing capital on a joint venture basis and not being a shareholder owner of the company, we're okay. We can do that. Okay. So it's a complicated field, but when you get into this stuff, either as an investor or somebody raising capital, just ask yourself, am I investing? Am I becoming a shareholder? Am I investing into a mutual fund trust unit? Or am I not? Or am I just investing into an agreement that the person I'm partnering with is buying real estate? So that's about as simple as I can make it, but it is a very complicated field. As David mentioned, there are exemptions when you get into the shares, the MFTs. There's a friends and family exemption. There are accredited investor exemptions. There's OM offering memorandum exemptions. So it's a very complicated field, as David mentioned. Get educated, get informed, talk to people like me and David, talk to a lawyer, just understand this as well as you can, because there are minefields out there and you have to be aware of them. So, but once again, it is, the rules are there to protect the investors. So it's purposeful. It's just, in my opinion, it's a little stringent compared to what goes on in the public market, in the market of stocks and mutual funds. But don't let that discourage you. Once again, as I said before, there's a lot of money out there chasing deals. And those of us that put deals together, that's what we want. We want this capital. We have to abide by these rules.
Kelly Hagan?
So yes, I think Jerry covered it off very well. I agree wholly. I do raise capital. I have chosen not to do an MFT for multiple reasons, and we do raise capital through a GPLP, joint ventures, just straight debt financing where they lend us the money as a loan. You do definitely need to get some really good counsel as you're going along, and we talk to our lawyers and our accountants on a regular basis to make sure we're still conforming and in line with where we need to be. So, and there's just so many different ways. We try to make our investments the least complicated that we can, because we like to do things by project and get in and out. Get in, to have our investors paid out as soon as possible, move on to the next deal. Some of those people roll their money back into the next deal with us. But we've chosen not to go the MFT or the offering memorandum structure,
Excellent.
just because of complications.
Right. Jyoti, you like to add something to it?
Yes, I have had clients who have come to me for joint venture agreements. A couple of friends or colleagues or relatives get together and they want a joint venture so that they can invest in real estate. Now, it's very essential to draw a joint venture agreement, to get it drawn by a lawyer, because every person is going to have a defined role rather, and every person is going to invest a certain percentage of the money required. So it is very essential that it is drawn up in a proper agreement and signed and witnessed, so that in future there are no complications with respect to the joint venture agreement and the rules of the different parties who are parties to the joint venture agreement. The other thing is, some people have come to me and they have formed a corporation. So basically, they buy property under the corporation, and maybe 3 or 4 friends have joined together, and they're the shareholders of the corporation. So in that scenario, again, it is important to have a shareholder agreement in place and to lay down the rules for the current time and the future, and if more shareholders are being added onto it. So that is an important part of the whole process.
Great, thank you. Now we're going to talk about our self-directed RSP. Again, as I mentioned, this is very regulated by Canada Revenue Agency. You have to follow the rules and regulations. Money can be invested in mortgages, stock market, GICs, and even REITs, which are real estate investment trusts as well. Again, it's entirely up to you, but majority of Canadians are not aware of all the options. In my opinion, when they invest in mortgages, especially in Canadian real estate, especially second mortgages, they can expect around 8 to 10% return. And that is pretty exciting for them because it is secured by real estate. Majority of the people who are going to invest in real estate might have their own principal residence. They might have a good clout, and they're looking for a mortgage. So I'm going to go back to David Grossman. David, RSP. Anything we should be aware of it?
Well, I mean, I'll take a page out of Jerry's book. Big problem people have with RSPs is they can get the money in, but they can't get it out. Or if you do get it out, it doesn't meet your objective. The idea with RSPs is you're supposed to be building it when you're in a high tax bracket and then pull it out when you're in a low tax bracket. Except that when people age, they tend to get busy with other things, and then they leave the money there, and all of a sudden they go and Jerry's doing their accounting, and he realizes, so they make a plan to start to unwind it. Um, so that's a problem. You got to be conscious of that, and it's not the only way to save in a tax-free, people can have or tax reduced method. You can use TFSAs if you're self-employed. You can have see how much I've learned from Jerry over the years. If you have your own corporation, you can keep some money in the corporation and pay yourself just what you need to reduce your taxes. So those are some of the ways, and some of these investments, like I was talking about Polis or Lankin, the apartment REIT earlier, and that's just one example of one. They're very tax efficient. So even if they're not inside of an RSP, they're largely treated as return of capital, right? When you're earning money on an investment, you're always wondering, is this interest, which is taxed at the worst rate, right? Interest income. Is it a dividend? Or what's the third category? You got interest, and you got capital gains, of course, capital gains. But when some of these REITs, real estate investment trusts, that you get money on an ongoing basis, it's considered a distribution, and it's distributed on an annual basis. But at the end of the day, it's treated as a capital gain, and it's not till much later till you decide to sell the security. So there's different ways that you can invest in a tax efficient structure, aside from just RSPs.
Thank you, Jerry. This is your cup of tea.
Yes, it is. And yes, David, we learned from each other, that's for sure. Yeah, boy, this is my cup of tea. Now, I will start by saying, those of you that know me, we're not fans of RSPs, okay? And the reason why we're not fans of RSPs is of what happens at end of life. And I don't want to get into that whole conversation at this point, but I've done over 600 final death tax returns, and I'm going to say close to half of them, we've sent 50% of the money to CRA, and the biggest culprit is an RSP. Now, that in itself is a topic for a different day. We look at RSPs not as an investment vehicle. We look at it as a tax vehicle. Okay. As David said, you don't need an RSP to build up money for your future. We use RSPs, and David said it best. You put it in a high tax bracket, you take it out at a low tax bracket. We'll do that all day long. But what we don't do is just continually put money into an RSP and keep it there till you're 70, 80, 90. We want to pull that money out at the low tax bracket. And once again, as I mentioned earlier, there's such a huge opportunity. There's so much money out there in RSPs, and there's a desire for that money to land into real estate deals. And just a simple explanation. So people have money in their RSPs, and they're like, I'd like to invest in real estate. Well, you can go to third-party real estate companies, like as David mentioned, REITs, Willis, Centurion. Those are fantastic third-party real estate investments that can be held inside or outside of your RSP. As we're learning tonight, and we probably already know, you can also hold mortgages inside of your RSP, and that's a viable option too. Now, what there's a large demand for, and what doesn't happen enough, is there's people who have money in their RSP, but they want to invest in Bob's real estate investment. There's the problem. Okay, how do we get that money from the person's RSP into somebody's smaller real estate investment? Let's say somebody wants to be a partner in an apartment building purchase, and they have lots of money in their RSP. Well, one option is to go to the third party REIT, but let's say they just want to use their RSP money to participate with their friend or their fellow investor and buy an apartment building. That's very common. And what we need there is a structure. And what it is, the structure is an MFT, a mutual fund trust, on top of a GPLP unit. Okay. And that sounds complicated, and it is. It's kind of simple too. If we had that structure in place, the money goes from the RSP, inside of the RSP, through the mutual fund trust structure into a a GPLP, general partnership, limited partnership structure. And that is where that real estate investment, that apartment building that they may want to get invested in with their investment partner, that's where that happens. Now, we just don't see that a lot. But that is something that actually I'm in the process of creating. I'm creating an MFT structure on top of, I'm not going to use a GPLP, I'm going to use a corporation, but we're creating this structure in order to facilitate that market where there's a lot of people with a lot of money in RSPs who just want to invest in single unit apartment buildings or 2 or 3 apartment buildings. So again, when we have money in the RSP, and the person wants to invest in real estate, they can go through someone like David and get a third-party REIT. Nothing wrong with that. They can lend it out, or they can keep it inside of the RSP and lend it out as a mortgage inside of the RSP. You all know that. But we want to accommodate those people who want to use their RSP money to invest in single unit apartment buildings or just smaller investments. So that is in the making. So anyway, yeah, it is my jam, this topic. So
Ellie Higgin, can I add something about RSP mortgages?
No, I think I think Jerry does a great job of covering that. Obviously, very knowledgeable. You train on that all the time. The only thing that I would probably add is that most of the people that I deal with have no idea that they can invest with their registered funds and are a little bit hesitant at first. So one of the things that we make sure we stress a lot is what their security would be, to try to, help them understand what that is with the risk. And not everyone has the risk tolerance to be a private lender. So that's one thing that I spend some time with, making sure they understand that the investment, could potentially be locked up for a year, maybe longer, just so that they get a comfort level when I'm dealing with those investors personally, those lenders as an investor myself. That's one thing I would add, but I think Jerry does a great job, and David as well.
Excellent. Well, a couple of things I'd like to add up for you. Number one, most of these lenders who have RSP money, they don't need the money till they're 65 or 72. So they are happy to extend it to you if you now you got the investor for life. Second thing, you have option to make one payment, balloon payments. Third thing is, what you are able to do with these people, these mortgages can be portable from one property to second property, again, as long as you follow the guidelines. Now, to my understanding, there are trustees which will be holding your RSP fund are now being asked to say, hey, you are not financing it 100% or 90%. Just be aware of it. Now, at one time, there was no problem. You can finance the property 100%, no problem at all. You got the first mortgage 75, 80%, whatever, and you put a second mortgage 20%. Now you got 100% financed property. The reason you don't not want to make a mortgage payments is so that you can have all the tax benefits ahead of the time. Hey, I'm going to be paying interest on this mortgage, but I have not paid it yet. It's other way around. Instead of paying taxes up front, this way you take the tax benefits up front and you pay that mortgage payment after 5 years or 10 years or so on. Again, all these things need to be done through the help of a CPA, definitely through a mortgage broker, and definitely a good lawyer at the same time though. Now, this thing is very similar when we talk about TFSA. Again, these are very heavy regulated. Again, this is something, as I said, all the scrutiny go through CRA, And we're going to be talking about next thing, which is a little bit more complicated. And people say, okay, how should I be raising capital? Now I'm going to get back to Jerry again, because this is more or less his cup of tea. Jerry, you want to talk about this thing?
Yeah, no, well, yeah, raising capital. Yeah, you've highlighted the options we have available. Certainly under the OSC exemptions, we're talking a very complicated path, but hey, that doesn't mean we don't go down that path. REITs, that's David's expertise. He's, there's still, I mean, listen, I've had clients invest in REITs for probably 20, 25, 30 years. I do not have one client that is not satisfied with their investments in REIT. These things, people need to be more aware of REITs. They are great. Okay. They give you a good return. There was a preferential tax treatment on them. So when people are looking to invest in real estate, they really need to look at REITs. Crowdfunding. Now that's an interesting and yeah, there's what's the company? ADDY is a company. They raise capital through crowdfunding. You can buy like 0.001% share. You can invest $1 into real estate through this Addy platform. And they also do crowdfunding. They'll list your project on there. People can invest in this stuff. It's an interesting new venue, new avenue for people to invest in. You're playing tricks on me now. You lost the screen. There you go. Okay. So crowdfunding is good. It's such it's a slippery slope. We as real estate people who structure real estate deals, we're all excited about what we do, and we're confident in that we can provide returns to the investor. But people need to be aware, there's risk in everything, okay? Everything. You put your money in GIC and you're going, well, okay, this money is safe, there's no risk. Well, there's inflation risk because most of the money sitting there in these guaranteed investments aren't even covering inflation. So there's that risk. As soon as you pull your money out of a GIC and invest in anything, be it a mutual fund, be it a stock, be it a REIT, be it other real estate investments, there is risk. And people need to be aware of those risks. And that's, as promoters of these types of investments, I think that's a very important job that we have to ensure people know the good and the bad. But it's such a healthy market because there's so many real estate groups and there's so many people that watch us that are active in the real estate groups and the real estate world. They want to be a part of this and they want their money invested in real estate. The desire of these publicly traded investments, i.e. mutual funds and stocks, are diminishing quickly. People don't like these things. They don't trust them. They don't trust banks. They don't trust mutual funds. Your money goes up and down. I just cannot believe that the industry looks at a REIT being more risky than a mutual fund or a stock. That is just the most ridiculous thing I've ever heard in my life. Yet that's the way the industry is structured. So I'm not saying you're going to change the way the industry is structured. You just need to be educated. Why does the industry say a REIT is more risky than a stock? Well, it's self-serving reasons. Okay, a REIT is protected by real estate. Real estate is valued at certainly multi-unit. The valuation is based on the rental income. Okay, what's going to happen to our rental income in Canada? What do you think? Up or down? It's going to go up. We can't build enough houses for the people that come into this country. We just heard our prime minister say we're going to now spend 5% of our GDP on military, $150 billion. Where's that coming from? Well, you got to increase GDP. Well, how do you increase GDP? You bring people into Canada so they can spend. That's how you increase GDP. You bring all these people in. There's nowhere for them to live. So our rental income that fuels the valuation of rental properties, which fuels the value of your REIT, is very strong. certainly compared to the other side of the equation, when we look at the public market and go, there is no valuation that protects the value of your share. All your share is reacting to is how they did the last three months. Okay, that to me is risky. It's certainly not risky when you have your money protected by the proper type of real estate. There's good real estate, there's bad real estate. So, but anyway, that's my little book.
Now we're going to talk about what kind of structure you can have. We're talking about limited partnerships, REITs, joint ventures, and so on. So I'm going to start with Shelley. Shelley?
Yes, actually, I just wanted to add one thing regarding mortgages that I had not mentioned earlier. Now, just kind of slipped my mind. In Western Canada, we handle those private mortgages differently too than you do in Ontario, because I would assume probably David he mentioned that he's licensed earlier. You have mortgage administrators as such that do syndicated mortgages where you put multiple lenders together into one mortgage, like a pari passu. In Western Canada, it is handled differently. We don't have mortgage administrators as such, and it depends on the brokerage. So I partner with a brokerage here in Western Canada that does not allow syndicated mortgages with the brokers within our organization. And so Olympia Trust does allow those syndicated mortgages. If you want to do one, then you need to probably work outside of that structure with a lawyer that can represent you. And not all the lawyers are comfortable doing that. But you know, Olympia Trust will do them, for example. So you do need to, you know, take that into consideration when you're going forward. So my apologies, I forgot to mention that earlier for anybody who's listening from Western Canada versus Ontario, because we tend to, most of your viewers are from Ontario. So regarding the structures, yes. So I've used a variety of different kinds of structures. Personally, we do a lot of joint ventures. We do a lot of personal loans, debt financing versus equity financing, and certainly corporate structures, JPLP, or just shares within a corporation, as we were talking about a little bit earlier. It really is good to talk to a lawyer and sit down and talk about what your goals are, how long you want to have this structure in place. If you're looking at raising a fund, then maybe it is worth your while to go to an MFT type structure, something similar. We can do a little bit different structure to a little smaller than an MFT through Axiom out here. So it's very important to get the right counsel as you're setting this thing up, and make sure that you and your partners understand what your long-term goals are for your investments and how you're going to handle those things going forward.
Well, there's one more thing we like to add up on it. It's not on your slides. It's called fractional ownership. And that's something one has to be careful, have to be designed by a lawyer. It's slightly different than a JV or joint venture. And we're going to focus again back to structuring the investment. What are the compliances are? David Grossman.
All right. Well, I mean, this is not exactly my area of expertise. I do work with clients, though, who are buying properties, and occasionally investors will come together. From a lender's standpoint, they just want to know who's on title and who's guaranteeing. They don't care if you own 10% or 50%. That doesn't matter to the lender, because essentially you're 100% responsible if you're on the mortgage. So you know, you can do this for single family homes or duplexes, triplexes, and you could do it for multifamily. 5 units and up. 5 units and up is considered a different product from a lending standpoint, where they look closer at the asset itself and how it's producing, and also what the potential is for the asset, versus what we'll call single family. 1 to 4 units is considered single family, where they look very closely at each borrower and you know, what are their assets, their liabilities, and their credit scores. their income, their expenses, and they look at it that way. So, but I don't know if that really answers your question too much or not, but it's what comes to mind. So I hope it has some value.
Yes. Vladimir, you've done a lot of joint ventures.
Sorry, me?
No, Vladimir. Sorry.
Yeah, yeah. Thank you, Uncle. I learned a lot. So I think I'm not really comfortable to give like advice, but what I always recommend, you have to when you looking for funds, you have to have backup because personally, me, it's happened like twice when we have everything arranged, everything was ready, all paperwork done, and 2 weeks before closing lender asked for a second phase environmental report, and lender and actually seller didn't allow to make more holes in their property. So in the 2 weeks we have to find a private lender, and then it's happened again. So because we have everything set it up, everything was ready, but when time like maybe a couple of days before closing, we have fire in our property. So then lender backup too. So what I would recommend if you're looking and for some when you have a closing, you're working on a mortgage. If it's private or not or not private, have some backup because it's take a while to do all the paperwork. If it's lender backup on the last moment, it's really hard and very expensive to find a good one.
Excellent advice. So what Vladimir is saying is what we have been teaching for a long time. When you have a joint venture partner, when you're going to have money coming in, make sure the money is in about 15 days ahead before the closing. So I don't mind paying the interest on it. I want to make sure that I have plan A and B. People intend to back off, things happen, life happens, if especially the money coming from the private sources. When it comes to RSP, TFSA, LIRA, they are okay with it. But when it comes to private ventures, they're totally different. But Vladimir have done a lot of deals as joint venture partner, where he partnered up with other investors and have done a bunch of deals together. Is that correct, Vladimir?
Yes, yeah, it's correct.
We have done a lot of deals because you're able to do those deals because you have multiple different partners available for you so that the deals are able to go through them.
Yeah.
All right, thank you. All right, we're going to bring again Jerry Hogenhout. Jerry?
Yeah, thank you. So when I look at these different types of structures, the most important thing is to figure out what the investor wants. That's where we start. Okay. And I always say the investor, are you a passive investor or an active investor? And some of them understand what I'm saying, others look at me and go, what are you talking about? A passive investor is just somebody who wants to put the money in and doesn't want to be involved with the day-to-day functioning of whatever the real estate investment is. An active investor wants to be involved. They see this as an exciting field. A lot of the real estate investors want to lean on people with more experience, so they get involved with them, but they want to be active. So for those passive investors, I'll go back to these REITs. That's where the passive investors go. That is, a REIT is the most boring investment you'll ever make. You don't have to do anything other than watch your money go up 8 to 10 to 12% every year. If you're an active investor, you don't want to be in a REIT. You want to be a partner of somebody, like me or anybody else that's creating these deals, because you want to be involved. And that my favorite structure is a joint venture. And the reason I find it it's my favorite because it's easy. Okay, the deals I do, when we buy a property, we put it into a corporation on its own, and we create the joint venture beside that. And sure, we need to get lawyers involved to look at this joint venture, but a lot of it is cookie cutter. to cover all the angles, and then we just put in conditions that myself or anybody else that's involved want to make sure it is covered. So I find the joint venture is a very suitable form for an active investor. I like the LP structure. That limits I mean, the reason it's a limited partnership is because you're limited. You don't have exposure beyond the money that you put in. So let's paint a bad scenario. You put money into an LP and the whole thing goes south. You can't lose any more money than what you have put in. And that's why you have an LP. And I'm not really, tongue in cheek on that one because, hey, we put money into a joint venture and it went sideways. I can't see how you lose more than what you put in there anyway. And on these structures, I just want to talk about, I know people like me and David and everyone else, we're throwing these terms around, but may or may not be confusing to your audience, but just for clarification, you've heard things like a prospectus, you've heard things like an offering memorandum. So I go back to the public market, stocks, mutual funds, and the private market, which we're talking about, real estate, REITs. The public market, for you to invest in a mutual fund or a stock, the regulators require you as the investor to receive what we call a prospectus. And to put it in comparison, let's say that prospectus is 500 pages. It's a huge document. Thank God we usually just do that electronically. Back in the day, here's your 500-page document called the prospectus for you to invest in a share or a stock of something in the publicly traded market. And the logic there is here's all the information. I don't know if I've ever met anybody who's read the prospectus front to back. But the logic is here's all this information, so you're informed, whether you read it or not. I shouldn't say we don't care, but here. So you've got this huge perspective. Now we go to the private equity, the private world, where it's not publicly traded stocks. And now we're talking about something called an offering memorandum, similar to a prospectus, but by comparison, let's say the prospectus is 500 pages, the offering memorandum is 100 pages. So it's a smaller version of the prospectus, and we use that offering memorandum as what we call an exemption. So somebody doesn't need the prospectus, they can just use the offering memorandum. Now, when we deal with another exemption called family and friends and what we call accredited investors, we don't even need to deal. Now we got another term that we call term sheet. Okay, so there's three terms: prospectus, that's information to the investor in the public market. There is offering memorandum, that's information for people on the private market side. And then there's what we call a term sheet. So if we're dealing with an accredited investor or somebody that would qualify as what we call friends or family, the term sheet can be 5 sheets. So very, very, very minimal information that is required, but it's still a requirement. The investor still needs information. And if they're creds or if they're family and friends, we just need to create a term sheet for them, and we're on site. So anyway,
All
that's
right,
it.
we are almost closing, almost at the closing because it's 8 o'clock. Everybody have a 30-second to add it up. In the meantime, I strongly recommend that you speak to your lawyer or security lawyer or tax advisor. You can speak to David Grossman. You can speak to Jerry Hogenhout, or you can speak to Shelley Hagan, or anybody else of your choice. It's important for you that all these things you follow it with compliances and the law. Final words, David. David Grossman.
Yeah, sorry, I had to unmute.
Sure, go ahead.
Thanks. Well, there's lots of investment alternatives out there, as it's been said before. You want to do your homework, look at your options, maximize your use of registered accounts where it makes sense. Make sure you speak with your accountant, Jerry, and people that you know and trust. This is my first time on a call with Shelley. So it was nice to be on with you, Shelley. Sounds like you're working on some very interesting things too. Of course, Vladimir, I know. from previous dealings. A very smart man. Haven't met Leonard yet, but in any event, Navtaj, I appreciate the opportunity to be part of your monthly sessions. In last word, 25% chance only of a rate decrease later this month.
And
So
21st of
that's
July.
sorry, yeah, and maybe a quarter of a point to a half a point drop later this year. Still, people are worried about inflation due to the last thing Trump sent out a letter to a whole bunch of countries. So there's still a lot of worries about trade issues and a lot of uncertainty out there. So find your opportunity in all of this uncertainty. Use your experts and make some moves.
Excellent. 15 seconds, Charlie Higgin.
Yes, so thank you very much, Navtash, for the opportunity to come and talk to the group as well. If anyone is from Western Canada and needs some assistance, by all means, please reach out. I, would love to have an opportunity to talk to anybody and look forward to next month's call.
Excellent. Jerry Hookenhunt.
Yes, thank you. Great session tonight, Navtash. Thank you for again including me on your panel. I think tonight was especially we covered a lot. I think we provided some good education for your listeners. If I can leave you with one thing to the investors who want to who want to invest their money, define yourself. Okay, figure out what you are. Are you an active investor? Are you a passive investor? What is the level of involvement you want in the investment that you're making? Let the people that are putting the deals together know that. Okay, so you're properly served. Make sure you talk about the good and the bad. Okay, again, the minute you take money out of a GIC, you have risk. Some has, so our job is calculating risk. So we want to make the client aware of what can happen, but good real estate can negate any of the risk that is involved in real estate investing as well as a proper structure. So again, thanks to the panel for their expertise and thank you now for the opportunities tonight.
Leonard, few words. Vladimir.
I would recommend for all investors when you're borrowing money, just give you extra time, especially when it's short term, because most of the time renovation is take longer than you expected.
Thank you. That's the words of real life wisdom. Thank you so much. Thank you everybody for being tonight. It's really appreciated. Next meeting will be August 12th, second Tuesday of each month. Once again, thank you so much for your time. And we will be recording the session. In case you missed it, we'll be sending it to you. Those who need the slides, make sure you are a paid member. We'll be happy to send the paid slide to you. Thank you and good night, everyone.